Great. So welcome you all once again to today's section. So we're going to look at the question solving of IAS 8, accounting policy, change in accounting estimates, and then errors. That is the plan for the day. Then we continue with the IAS 10 and 12. Okay. Now we started with the question solving of the IAS 8. Today I want us to look at some two questions, some series of questions so far asked by our examiners. So let's look at this. Okay, so let's look at the question one. Then you tell me how you are going to respond to this question. So question one, required. Discuss the procedure for selecting accounting policy. Recommend how entities should account for a change in accounting policy. So how do you respond to this question? The question moves like this. IAS 8 accounting policy changes in accounting estimates and errors is applied in selecting and applying accounting policies. Accounting for changes in estimates and reflecting correction of prior period errors. The standard requires compliance with any specific IFRSs applying to a transaction, event, or a condition, and provide guidance on developing accounting policies for other items that result in relevant and reliable information. Okay. So discuss the procedure for selecting accounting policy. How do you select accounting policy? How? So here 3 marks means raise at least 3 points for us. Each point should score you 1. Okay, so procedure for selecting accounting policy. What are the procedures for selecting accounting policy? Okay, so do you have to select any policy at all? Or there's a specific procedure? According to the standard, IAS 8 states that the entity should select one. So the point. So the procedures are, so the procedure for selecting accounting policy, the accounting policies. I put them the points. One, select an accounting policy which is what? Appropriate. So first point, select appropriate accounting policies. Number 2, which comply with IFRS. Wow. So comply with what? With IFRS. Number 3, the policy that make the financial statement reliable. That results in reliable presentation. So policy that results in reliable presentation. So reliable presentation. Again, you can tell us that reliable in a sense that make the financial statement faithfully represented. So faithful representation. Faithful representation. Again, which is what? Relevant. That's all. So basically, that is what we are looking for. Then second question, 2 marks, is saying recommend how an entity should account for a change in accounting policy. How do you account for a change in accounting policy? How do you account for a change in accounting policy? How do you account for a change in accounting policy? So let's see, accounting treatment for a change in accounting policy. So let's see the accounting treatment for a change in accounting policy. Now, a change in accounting policy must be accounted for retrospectively. That's the first point. Account for the change as if the change or the new policy has always been there. If not change of policy, that is the section. Okay, so let's go to that one. I'll be just some few points down. So accounting treatment, the second section, accounting treatment of a change in accounting policy. There are 2 marks, right? So we need 2 points. 2 points. The first point, the change must be accounted for retrospectively. So tell the examiner that the change must be accounted for retrospectively. Retrospectively. Meaning that, so full stop. Retrospective application simple means retrospective application simple means we have to adjust the opening balance of the retained earnings. That is the actual meaning. Or you can continue. Tell the examiner that as if the new policy has always been there. That is it. Then come again, tell us that adjust the open balance of the retained earnings. That is all. With the effect of the new policy, with what? The effect of the new policy. That's how it's not coming in. With the effect of new policy. So in short, the point A, just tell the examiner that first retrospective application, second sentence, it must be accounted for. Just adjust the opening balance of the retained earnings. That's all. So that's the meaning of the retrospective application. Very important. Adjust the opening balance of the retained earnings. That is a retrospective application. This one is just 1 point. Just 1 point. This is 1 point. Point number 2. Point number 2. Apply the new policy in the current Yeah. Okay, so in short, in summary, the point A, the first point, tell them that the change should be accounted for retrospectively. And then by adjusting the open balance of the retained earning, that's all. That's the first point for 1 mark. Then point number 2, how should they apply the change in the current year? So B, the new policy must be applied in the current year, onwards, in the current year and the subsequent periods or years. That's all. Point number C. Yes, that's third point. At least you raise 2 points for 1 mark each. Comparative information must be restated. Tell the examiner that anytime there's a change in accounting policy, comparative information must be provided or restated. Comparative information must be provided. That's all. Because if you change the policy, if you change an accounting policy and you don't provide the comparative information, it will distort comparison. So that's why I say comparative information must be restated. Yes. That is all. So any of these 2 points, you are free to go and score the 2 marks. We are done. Let's continue with the questions. The B part is also interesting. 2 marks. So, according to IAS 8, accounting policies, let me sound this very clear for you. Both student and examiner, if you quote any standard, you have to tell us what that standard means, the name. So if you don't want trouble, don't quote. So if you quote a standard, kindly write the full name of that standard. Both students and examiners. So you see that here they quoted the standard and they're writing the full name. Don't go and say IAS 8 says, what is IAS 8? So according to IAS 8, accounting policies, changes in accounting estimates and errors, an entity must select and apply an accounting policy consistently from one period to the next and among various items in the financial statement. However, an entity may change its policy or its accounting policy under certain conditions required. Identify the circumstances under which it may be appropriate to change accounting policy in accordance with the guidance given in IAS 8, accounting policy, changes in accounting estimates and errors. 2 marks. So here to 2 points. That's all. 2 marks, 2 points. So when do you have to change your accounting policy? When do we have to change accounting policy? The standard gives only 2 conditions or 2 circumstances in which you can change your accounting policy. 2. Only 2. Only 2. Okay, so I'll take that. Can you give us an example? Only two. Okay, I'll take the first one. If it is required by what? IFRS. Okay. If it is required by IFRS. So the conditions are only two. Number one, if it is required by by IFRS or IFRS interpretation committee. IFRS interpretation committee. Good. If it is required by an IFRS, or you can tell us that financial reporting standard, an accounting standard, or the interpretation committee. Now, the interpretation committee can also give a guidance for you to adopt a new policy. You can key in that. It's required by interpretation committee. Good, I'll take that. So if it will lead to what? More relevant presentation, That's all. So if it will provide, more relevant, I like that too. Relevant presentation. Of what? Transactions and events. Transactions and what? And event. That's all. In the financial statement. Okay, so these are the only two conditions stated specifically in the IAS 8 that you can change your accounting policy. Here we are saying that the accounting policy once selected or applied must be kept the same from time to time to enable what? Comparability. There must be a consistency in the policy. Unless one, there's a need for it. And these are the needs. One, if the IFRSs give a different treatment or change the accounting treatment. Two, if the new policy will provide what? More relevant presentation than the earlier or previous one, just change your policy. That's all. Aside these two conditions or circumstances, you are not allowed to change your accounting policy. That is it. So take notes of that. Take notes of that. I'm done with this particular question. Now, what left is for us to look at some calculation, complex questions. Good. Then we move on. The next set of the question, I think I'll look at it. this set of questions, we look at it. Okay, now let's look at this particular question to end the IAS 8. The rest of the questions are your own. I am still waiting for the solution to this particular question. Where is that question? In our last meeting, there was a trial work. I'm still waiting for the solution. So if you have your solution there, you can let me have it. Or you can solve it. You can take a screenshot of it and then go through it, solve it, forward the answer to us. We review it and get back to you. Great. Now let's look at this particular question. Let me go straight to the question. Required. Explain the above transaction. Explain how the above transaction will be treated by Good Works Limited. Good Works. Second, prepare the income statement and a statement of changes in equity into bracket retained earnings column only for 2019 and 2018 as comparative in accordance with the IAS 8 accounting policies, changes in accounting estimate and what errors. Have you seen that? When you quote a standard, you have to tell us the meaning. It's against the rule. So if you don't want trouble, don't quote. Okay. Let's go through the question. Now, once there was a comparative information, like when you see the word comparative in a question, then that means that question, it might be a change in accounting policy or it's a prior period error. So let's see. Or you can have both. Good Works Limited is a leading manufacturer of furniture works in West Africa sub-region. The company manufactures varieties of furniture works. During 2019, Good Works Limited discovered that some item of furniture valued at $33.6 million sent to one of its agents had been included in inventory as at 31st December 2018, which had been sold before the year end. Okay, so in short, if I should understand this one very well, they dispatched some furniture, some goods, at a cost of $33.6 million US dollars. Then these goods had been added to their inventory. Meanwhile, that had been sold before the year end. So before 2018, the goods were not there. It has been disposed of. So probably that could be an error. Yes. So it means that some of the item that they've added to their inventory does not exist. It has been sold. So therefore, we have to correct that. That it was discovered in 2019. So they say during 2019, the error took place in 2018, but the discovery was when? 2019. So that's why we call it prior period what? Error. This error is not 2019 error. Okay. Now let's continue the game. As a result of this, so there must be a comma there. As a result of this, agent commission of 10% of the sales value have not been included, has not been included or accounted for. The company normally makes a profit margin on its agent sales of 20%, full stop. However, the value of these goods had been included in 2019 draft financial statement. That's the income statement. So that means it was included in closing inventory in December 2018. So in 2019, it will be there as what? Open inventory. Open inventory. That is it. Now let's see. The extract from the income statement for the years ended December 31st, 2019 and draft or as drafted and then 2018 as reported. Let me explain this one very well. When you say drafted, drafted means it has not been what? Published or authorized. We've just prepared it. We've just drafted it. We've not presented to the general public. So the current year financial statement has not been published, yet to be published. And 2018 has been published. So that's why we call it reported. It has been reported. So that's the difference. If you see them anywhere or the examiners are using it, that's the actual meaning. So you can also use it. Drafted report, that means we've not what? Published it. And then reported report. It has been reported. Good. So have you seen how we write your exams? You draft it your point first before you report it on the answer booklet for us. Okay, so let's see. Revenue up to profits after tax. So all of them are there. Now, as at January 1st, 2018, the retained earnings balance was $900 million. The corporation tax is 25% per annum. Full stop. So explain how the above transaction will be treated in the books of good works. So first, we are just asking for whether it to be accounted for retrospectively or prospectively. So this is error, a prior period error. So it must be accounted for retrospectively. That's all. As if the error had never occurred. So tell the examiner, it must be accounted for retrospectively. Or we need what we call retrospective restatement. So we have to restate the open balances of the retained earnings with the effect of the what? The error after being corrected. That is all. I am interested in the second one. I'm interested in the second point. Okay, so I'll start. They say we should prepare income statement. I gave a clue on how to solve errors and changing accounting policy. There are 3 steps. Step 1, step 2, step 3. Whether it's an error or a policy, follow these 3 steps. 1, identify the change in accounting policy or the error. This particular question is an error, so I have to now limit myself to error. So identify the error and then the affected area. So identify the error and what? The affected area. Affected area. Then 2, the impact. Here, has it increased something or decreased something? Then last one, the correction. Now you correct it before you now correct it. So the correction. That's all. So these are the steps. So first step, what type of error is this? Or which area of the financial statement will it affect? Or which item will it affect specifically? So let's see the question. In summary, an item of 33.6 million had been added to that of the inventory. Meanwhile, that item does not exist. So That is error.
It's correct.
Okay. So first of all, it means that the closing inventory has been overstated. That is the mistake that they've committed here, because they've added 33.6 million to the closing inventory. Meanwhile, this goods is not in existence. It has been passed on or disposed of. So that's the mistake. So which area will it affect? So just that here, one mistake leads to the other. So let's look at one first. So first, the error is that closing inventory has been what? Overstated. That's all. So to affect what? Affected area, cost of sales. That's all. So any figure that the examiner will give it to you aside cost of sales, you are free to pick them. You are free to pick those figures. Why? Because that figure will not be affected as a result of this error. Good. So take note of that. Then you look at the impact. So if closing inventory has been overstated, so that means the cost of sales, they've blown up the closing inventory. So we have to take it off from the closing inventory. That is all. Now, in one instance, it's a closing inventory. That's 2018. It's a closing inventory. But in 2019, it becomes what? Open inventory. So one mistake crossing over to the next period and still be in there. So let's see. So this is how I will look at the impact before I go to the commission. So in 2018 and 2019, in 2018, the error was that closing inventory has been overstated. In 2019, it was open inventory, which has been what? Overstated. Now, what's the impact? If you overstate your inventory, what's happened to your cost of sales? So that means more has been subtracted. You know, a certain item has been added to the closing inventory. Meanwhile, at the end of the year or at the end, this goods is not longer available. So in short, we have to reduce the cost of sales. In short, we have to reduce what? The cost of sales. Good. We have to reduce the cost of sales by this amount. Let's just cite an example here. Now, you have open inventory of, let's say, 300. Your purchases is, let's say, 1,000. And your closing inventory, you have subtracted just 500. So, meanwhile, the right one, the actual, is still 300, is still 1,000. Here must be 400. So it tells us that the actual cost of sales should have been what? 900. But because of this mistake, you've added certain goods which are not in existence to your cost of sales or to your inventory. The closing inventory is supposed to be 400. But here it's 500. Why? Because certain goods has been added. Meanwhile, these goods are no longer in existence. So how would the cost of sales be? So cost of sales here will be what? 800. Great. So the cost of sales here is what? 800. Now, this is the game. The actual cost of sales here is 900. Meanwhile, the wrong version is what? 800. So what do we do? So as a result of me overstating the closing inventory, we have this is an error. We have overstated the closing inventory. It has led to what? Under statement of what? Cost of sales. Good. So now the impact will be under of what? Cost of sales. So the cost of sales is too small. So what do I do so that I can get this 900? So it means that the closing inventory has been what? Has been overstated by 100. So I just have to add it. So here plus the 100 will now give me what? The 900. I'm able to what? Solve it. That is all. Now, the reverse is true for what? Open. So in 2019, the cost of sales should be what? Overstated. That's all. So in 2018, the cost of sales will be understated. 2019, the cost of sales will be what? Overstated. That's all. Now, how do you correct it? So the correction. If you know this, you now come and then correct it. So here you add. That's been under. Under means add. Anywhere you've under treated something, you have to add back. So add back to the cost of sales. Over means you have taken more than you're supposed to. So the cost of sales has been overstated. So what do? We subtract. So treatment, subtract. So that 33.6 million, add it to 2018 cost of sales and subtract from 2019 cost of sales. That is the treatment. You are done. Please, it must be the cost. Kindly pick cost. Kindly pick what? Cost of the closing inventory, not the sales price or the selling price of the closing inventory. No, it must be valued at cost. It must be valued at what? Cost. Great. Okay. So that is all for this particular error. So in short, we are done. Just that here, the first error leads to another error. So like a collision. So let's see the next one. They said, as a result of this, agent commission of 10% of the sales value have not been accounted for, or has not been accounted for. The company normally makes a profit margin on its agent sales of 20%. So, you know, the cost of the goods is 33.6. Now we have to find a selling price so that we can now find the agent commission of 10%. That is all. Because we have added it to our inventory, we have seen these goods as what? Unsold goods. Meanwhile, the guy have able to what? Dispose it of. So then we have to pay him his commission. We have to pay the commission. So first of all, we have to calculate the selling price. So let's go to the board. What we have done is the first error. So this is error 1. Error 1. They mistakenly added goods which has been disposed of to their inventory in 2018 and passing it on to 2019. We have solved it out. Let's go to error 2. Error 2 will affect which year? Which of the years? It will affect only 2018. Error 2 will affect 2018. That's the omission of the agent commission. I like that too. So error number 2. If you're able to understand this, that is all. So error number 2. Error number 2, which is what? Omission of the agent commission. Agent commission has not been accounted for in 2018, which is an error. How do you get agent commission? They say 10% on the sales value. So let's look for the sales value. The cost of the goods is $33.6 million. The profit margin is 20%. So profit is what? 20% margin. So how do you get a selling price if this is margin? Okay. Now, can you try it for me? If the cost is 3.6 million and then it was disposed of at a margin, what would be the selling price? Okay, let's work it together. Now, I'll solve this one in 3 different ways. Just pick one. Please, there's no topic in financial reporting that will treat markup and margin, but we need this one in our calculation, especially consolidation. Good. Now, the cost is 33.6 million. Profit is what? 20% margin. Now, profit is 20% margin. So what is the sales value or the selling price? So profit is 20% margin. What is the sales value? Okay, let's quickly provide the sales, because after we get the sales, then we find 10% of it, that's the agent commission. Then we treat it, right? Okay, so that's it. So the issue is this. If you're not able to find the sales, that means the agent commission will be wrong. And you have what? Even worse the case. You thought you are correcting the error. If rather what? Worse the case. So how do you get it? First method. So method 1. Imagine margin is on sales, right? So when you see margin, it's on what? Sales. Margin is on sales. The one that is on it, that means sales is what? 100%. Wow, that's interesting. So under margin, sales represent what? 100%. Yeah. Profit is always X%. So the profit is what? X%. And then here is 20. That's the profit. So bring the profit here. Now, let's say the truth too. If sales is 100 and profit is 20, what will be the cost? Cost will be, if profit is 20, sales is 100, then the cost should be what? 80%. That is all. Now that you know, then you start elementary. If 80%, which represent the cost, is equal to 33.6, then 100%, which represent the sales, will be what? Question mark. We don't know. And you solve for it. Good. That's the one method. That's the 1 star of doing this. Just one. There are 3 different styles. So in short, I'll get something like, after I do this, let me give another shortcut. What are you looking for? I'm looking for the 100%, right? So divide it. Pick the 100. divided by what you have. I have the 80 times 33.6. So answer. So what do you get? So 100 divided by 80, that's 1.25 times 33.6, which is 42. Perfect. I like that. Yeah, someone had the answer correct. 42. So the sales is what? 42 million. Good. That's the first style of getting the 42 million. Please, this section is not part of IAS 8. IAS 8 has nothing to do with finding selling price, finding cost. No, 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 no. That's not IAS 8. It's something that, yes, it might be part of you. So take note. That's the first style. Let me just use one more. Another method. Let's go to elementary. Let's go to elementary. Elementary means at the basic education. How do you find profit? We say profit is equal to, or how do you find selling price? So let's start like this. Selling price is equal to my cost plus what? My profit. That's all. Write this. If you're able to get this formula correct. Now, what is the selling price? That is what I'm looking for. It's equal to what's the cost? I know the cost. 33.6. What's the profit? I don't know. Now, this profit, if you are using margin, so here we are using margin, so it will be percentage of what? Sales. So it will be 20% of what? Of S. So 20% times S. That is all. How we get it? 20% times S. That is all. If I'm using markup, it will be 20% times what? Cost. That is all. So here will be 20% times the S. So it will be plus 0.2S. Make S the subject, elementary. So let's solve it together and see the answer. So make S the subject. So this S must visit his friend here, right? Okay, so come and visit your friend. If you come, it will be S minus 0.2S, which is equal to 33.6. S minus 0.2S, what will be the answer? That should be what? That should be 0.8S, right? So let me continue. So 0.8S is equal to 33.6. So therefore, S is equal to 33.6 divided by 0.8. Answer. You get the same thing. That's elementary. The third formula is in a certain video. I'll upload it on the platform. If you want to see the third formula, you watch it, then you get it. Once you're okay with these first two, you are fine. So okay, let's continue the game. So we are done finding for the selling price. Now let's find the agent commission. So the agent commission will be 42 million times 10%, and that will be 4.2. Because they thought they've not disposed of or they've not sold these goods, they did not accounted for the agent commission of 4.2 million. So what do? We have to account for it for them. How do you account for the agent commission? It's an expense. So in the P&L, where will it be? Agent commission. So you can charge it to cost of sales. Cost of what? Sales. Yeah. So you can charge to cost of sales because it directly relates to the goods sold. So agent commission, charge to cost of sales. Or if you are confused, you can charge to operating cost, but it will relate more of what cost of sales than what operating cost. That is all we are done. We are done for this question. So you charge the 2018. So in short, in 2018, we are adding two items, the cost of the goods itself, and then we're adding the agent commission to it. So now let's now prepare the extracts. We are done with this question. You just left with the calculation. So let's present the calculation for the examiner. So let's go to II. Prepare income statement and a statement of change in equity. So income statement. So Good Works Limited. The name of the company, Good Works. Good Works Limited. So Good Works. Let's go up. Good. So Good Works Limited. Then I'll start. Let me start around the demarcate border. So I'll do the income statement here, change in equity here. So Good Works. Good Works Limited. I'll tell the examiner that income statement. I am preparing income or statement for the year ended. Now I have to watch the question carefully. How they've arranged the years. Please arrange according to how they've done it. Have you seen they have 2018 here, 2019, right? Mostly, when they ask for the question, they ask for 2019 and 2018. In reality, if you're preparing financial statement, the current year must come first, and the previous year will follow like this, comparative. When you do this, there was about 85% chance that you copy wrongly or you get a mistake with this particular question. Now, if you check the question, the examiner have arranged it 2018, 2019. And then on your solution, you have made it 2019, 2018. So if care is not taken, you pick wrong figure. And there's about 85% chance that you mistakenly pick wrong figure. So to avoid trouble, let's arrange it as the examiner have done it, okay? Even though in reality, this is how it's supposed to be arranged, current and previous year. So take note of that. So yeah, I'm going to arrange it like the way the examiner have arranged it here for us. So 2018, 2019, great. So let's see, 2018, 2019. So take notes. Could have continued. If you solve it, you can still maintain it. So 2018, and please write comparative against it. Comparative. The previous year is for just comparison purposes. And 2019. Don't forget your reporting currency. It's in dollars. Millions of dollars. Where they started from, you also have to start from that angle. They start from sales revenue, 580 and 650. So sales revenue, 580 and 650. So 580 and 650 respectively. So revenue, 580 and 650 respectively. Let's go to our cost of sales. We said that three issues or three items. There are two errors there. So let's see how best to affect our cost of sales. Write your cost of sales here, cost of sales. Now the item that we are going to do here, there are many. So let's go do the working somewhere and bring the answer in. We could have just do it on the first part. So workings, examiner. Please, my workings number one is on cost of sales. Cost of sales. Okay, so I'll start 2018, 2019. Please and please again, arrange it like this format, like the question format, so that you don't mistakenly place certain figure there. Okay, we have a testimony. That is why I'm saying this. So per the question, what's the cost of sales per the question? Let's go and pick it per question or per the draft and report. 250 and 280. So 250 and 280. Don't forget your reporting currency. $1,000,000. So the cost of sales per the question will be, so per question, 250 and 280 respectively. Then the errors that you've identified, the eye effects. So errors. Number one will be the inventory. Error on the inventory. We said that in 2018, the cost of sales has been understated. So we have to add back. So add back 33.6 million to that of the 2018. And we said that in 2019, the cost of sales will be overstated. So subtract. Perfect. Second type of error that they've committed is the agent commission. So agent what? Commission. We are charging it to cost of sales. You can also charge it to what? Operating expenses. However, it relates more to cost of sales than the operating cost. So take note. We calculated we have 4.2 million, right? So 4.2 million. That is all. Here is dash. It will only affect 2018. So take note. So what's the actual cost of sales after the adjustment? So 250 plus 33.6 plus 4.2. That'll be 287.8. Agreed. So 287.8 million. What about 2019? That'll be 280 odd minus 33.6. That'll be 246.4. 246.4. I hope you get this. Good. So let's quickly move it in. 287.8. Put it in brackets. 246.4. Put it in brackets. What is the gross profit? Any other item that do not depend on the cost of sales, we call it free marks. Just carry them in. So let's see. So 580 less 287.8. 580 less 287.8. That should give us something like 292.2, right? So 292.2. Then 650 less 246.4. That's 403.6. So 403.6. Then operating expenses will continue. No error, no mistake will affect it. So we just have to look at it. So let me copy down fast. Operating expenses 161.8 is free. It's free. In fact, let me say this. In the original question, or like in the mind, when I was setting this particular question, I thought I've put a note in a question that suggests that the commission should be charged to operating cost specifically. But upon going through, that note is not there. So it means that we can still charge the cost of sales or the operating cost. That makes the operating cost free, because now I don't want to have any free marks. The only free marks should be the sales revenue. The rest are not free. But as a result of that sentence omitted from the question, there's free mark. Good. So that is it. That's why it's not good for you to set a question and mark it at the same time or provide solution. So 160, 180. So 160, 180. Prepare the income statements. So we take it off. Those with calculators, you can help me out and finish quickly before we move on to the agenda for the day. So 292.2 plus what? 160. That'll give us 132.2. So 132.2. Then 403 dot, okay, 223.6. Great. 223.6. So that is a profit before tax. What do you go again? Tax. So let's bring the income tax. Now income tax, let's go into the workings. That will be workings number 2. So continuation, workings 2, income tax. So workings number 2, examiner. Please go to my workings 2. You see the tax calculation there. Per the question, let's go and pick the tax. Per the question or per trial balance. Per the question given us, the income tax is what? 3438, right? What is the tax rate? The tax rate is 25%. So 3438. So 34 and 38. That is the income tax expense. Now, what are the errors? Let's go to 2018. In 2018, error on inventory. Certain goods were added to the closing inventory. Meanwhile, they don't exist. So in short, we said that the closing inventory was overstated. However, it causes what? Understatement of who? The cost of sales. So the cost of sales was understated. If you understate your cost, what happened to your profit? You blow it up. So profit will be overstated. So if cost has been understated, then profit will be what? Over. So this profit, will be overstated. So the profit has gone up as a result of this error. And you know, profit and tax are like twins. They move together. Profit and tax. So when your profit is high, what happened to your tax? It's also go high. That means that 34 that we have provided there is totally high because of this error. So what do? Reduce him, bring him down. So we have to bring him down. So this tax that is stated there, in fact, is too much. You have to reduce. So I write here error or inventory into the tax effect. What was the error? It was 33.6. 33.6. Multiply that one by the tax rate, which is 25%. And you have to what? Subtract. Why are we subtracting? Because as a result of the mistake, it has caused the tax to be more, because the more profit we get, the more tax. So mistakenly, our cost of sales has been understated, and mistakenly, profit has gone up. And once profit has gone up, tax has also moved in the same direction. So as a result of that, we should just subtract. The reverse is true. In 2019, just have to add back in 2019. That is all. So let's see. So 34 million. So 34 million times 0.25, that's the 25%. That's 8.5. So the tax will be 8.5. So that means the tax has gone up by 8.5 in 2018. So what do you do? Let's subtract. That's the implication. Let us subtract. And then because in 2019 the inventory has been the open inventory has been overstated, causing the understatement in what? The closing inventory. So the profit has what? On now. In 2018, our closing inventory was overstated. So therefore, cost of sales was smaller. Fine. Profit went up. So when profit went up, tax also went up. So now we have to reduce it. In 2019, it was open inventory. So open inventory was more than it's supposed to. So which causes overstatement in the cost of sales. So the cost of sales was overstated. So what happened to the profit and then the tax? So in 2019 is in effect the profit will go down. So the profit has went down because of this error. And when profit go down, what happened to tax? Tax also go down in 2019. So this is 2019. So that means you have to add back 8.5. You are adding back to 2019 financial statement. Right. So that is error number one. Okay. This question, in fact, you have to solve it again. You have to solve it again with combined forces. Number two, error number two, the commission expenses. Some of the expenses were understated. Commission was omitted. So if commission is being omitted, that means the profit was overstated. Profit was overstated. Because of the commission, profit has gone up. So therefore, what happened? Tax has also gone up, right? So to correct it, let's reduce it. So let's go to the commission. You find the tax effect. The commission was 4.2 times 25%. That is also 25% times 4.2. So 4.2 times 0.25, which is 1.05, right? So 1.05. That one you subtract. Okay. Here is dash. We are done. Okay, so finally, what is the right tax that needs to be paid or that needs to be provided? So putting all this together, so 34 minus, so 34, less 9.55, less 9.55. That will give us 24.45. So 24.45. So 24.45. So 24.45. You put it in brackets. 24.45. You put it in brackets. What about the other one? 46.5. So 46.5. Perfect. So 46.5. You put it in brackets. What is the profit after tax? Antipart. Then we are done. I'll just work on the retained earnings or the change in equity. Then I will look at the IAS 10. Or IAS 10. Now let's see. H and this What do we get? 132.2 less. So 107.75 and dot 75. Then 223.6 minus 46.5. So that would be one last figure. Okay, so that is it. 223,177.1. Okay, so 177.1. That's the final answer. Okay. Now let's look at the changes in equity, the B part. This is the income statement. How would the income statement look like after the correction of this? Okay, so now let's look at the the changes in equity into bracket the retained earnings column only. So still the name of the company must appear. So Good Works Limited. Good Works Limited. So the name of the company should appear. So this one is changes in equity. Changes in equity. Into bracket retained earnings only. Retained earnings column only. Okay. Here too, I want current year. How we have arranged this, let's do the same thing there. How we have arranged this. So we have 2018 here and 2019 into bracket comparative, right? All the 2018 figures are what? Comparative. Then write it to 2018 into bracket comparative 2019, and then you write your currency. Pick the opening balance. What is the opening balance of the retained earnings? So the retained earning opening balance, let's go and pick it. The retained earnings balance will be, the examiner have to give it to us. They said as at January 1st, 2018, the retained earnings balance was $900 million. So that's 900. Check the date. It's as of 1st January 2018. So 900. So this one will be 900. How do you get an opening balance for 2019? To be on the safer side, take this 900, add the wrong profit. Please add what? The wrong profit from, or the profit from the question. The profit from the questions. So let's go to the original question. 2018, they made a profit of 136. Kindly add it to this. It will give you the opening balance, the wrong opening balance. So you add this 136 to this. So that will be 900 plus 136, right? So plus 136. And that should give us something like 1036. So here should be 1036. Now right here, error. The error. Now, these two open balance, which of these two contains the mistake or contains the error? Is it 2018 own or 2019? Okay, in fact, these two figures, the error contains in 2019, not 2018. No, 2018 does not contain the error. Why? Because this one is open balance coming from 2017, and there's no mistake in 2017. No part of the question suggests that 2017 they had a mistake, which has been carried forward. No. The mistake occurred in when? That's why we did something like this. How do you arrive at this figure? We pick the open balance, which is mistake free, add the 136 to it, which contains the error or the mistake. Because this is the profit for 2018. Before we had this, so this one contains the error. That is it. So the error is at this section. So let's correct it. Now here we have to pick the net of tax. The error, we have to pick the net of what? Tax. Okay. So see how we are going to correct the error. Now let me do workings here. So workings number 3, error itself. So I just want to find the monetary. First, inventory. The inventory figure, dollars say million. The inventory figure was 33.3. Find the net of tax. That's all. The tax rate is 25%. The net of tax is what? Because all the items that move to the changes in equity, it must be after tax. Changes in equity represent items that are after tax or with their tax effect. So 33.6 times 75%, because the tax rate is what? 25. Or in short, just subtract the tax that we had. The tax was 8.5. You can just tell the examiner that 33.6 minus the 8.5 that we calculated. It's also correct. Yes, it's also correct. Whichever way you do to get the answer for us. But I'll do that one. Just subtract the tax minus 8.5. So the net of tax will be, so 8.5, 33.6 less 8.5. That will give us 25.1, right? So 25.1. Will you add or you subtract? Will you add or you subtract? Now this is the closing inventory. So here we are saying that the closing inventory was overstated. So it has, the closing inventory was overstated. Good. So if the closing inventory is overstated, it has caused the cost of sales to be what? Understated. And if the cost of sales understated, the profit has gone up. So the profit has been overstated. They grow the profit. So let's reduce it. So here I'll come here and then I'll subtract. So, or you can just do this one on it like that. So inventory, error dash. I'll put a 25.1 here. And I will subtract. Why am I subtracting? Because they what? Blow up that of the profit. Let's go to the last type. That is the commission. So agent commission. That one too, it was 4.2. And then the tax element, the tax section. So 4.2 times 0.75. That gives us 3.15. That one too, commission, an expense has not been charged. So that means we will subtract. So agent commission dash, which is 3.15. That one we subtract. Why are you subtracting? Because an expense that they've not charged. So in correcting it, change in equity have to subtract it over there. So at the end of the day, we are done with the effects on the errors. Then what do? We have what we call restated open balance. Restated open balance. Please, no shortcuts. It's not good. That's why I shortcut it. So here, the open balance for 2018 is correct. No error will affect it. It is the current year's open balance that will affect, or that will be affected. So 10 36 less 25.1 less 3.15. That's 1007.75. 1007.75. Then add the correct profit to it. Add the correct profit after tax to it. The correct profit after tax is here. 2018 is what? 10.75. So 10.75. 2019 is what? 177.177.1. Put them together. Okay, so it means that closing balance, this becomes the closing balance, or let's call it balance carry down. Putting all it together, I get 1007.75. Then you put this one also together. So plus 177.1, right? So 1184.85. So 1184.85. So if you do it well, your closing balance here should be the same as the open balance, the restated open balance. Then it has balanced nicely for you. So that's the end of this particular question. This is the solution to drop 5 or so. This is the solution to drop 5. When you get this question, kindly solve it with care. Drop 5. Okay. Now, when you are done with this, kindly try these questions if you do have them with you. The tutorial questions, question number 1 has been solved. Tutorial question 1, the solution is in here. Either the solution is in the solution will be this. This is the solution to that particular question. Good. This is the solution to that particular question. Okay. So let's go back. Tutorial question 1 is your own. Kindly try it. Question 2 is your own. Kindly try it. Question 3 is also your own. Kindly try it. And question 3 is going for $50. So solve it for $50 to get it right. Then total question 3, this is the requirement, is going for $50. All the two, not just the A, not just the first part, all the two. And if any of them is wrong, you forfeit the entire $50. Then question 4 is November 2018 ICA Ghana past question. And please, this particular question, question 4, I need the solution by the close of tomorrow. So kindly solve this question for me. The first person that will send the solution, I will solve with you. Yes, so I will solve the question with you if you go through this. It's called tenancy. Tenancy. That is the question. It's very interesting and nice question. That is all. So on that note, we are done with the IAS 8. That is accounting policy, change in accounting estimates, and errors. And we've gone through a lot of questions. Starting from here, this particular set of questions. That's the theory section about it, and going through the calculation. So if they should drop it, you are fine. Good. So now let's move on to the next topic. So kindly join us when you're looking or when you're doing the next topic. If you have not subscribed, kindly do that. Share the link to your friends. Okay.